Welcome back to Money Pop. The German economy is broken, and right now it seems like nobody has the tools to fix it. Factories across the country are shutting down one by one. Iconic names such as Volkswagen, BMW, and Mercedes are struggling badly. In 2024 alone, almost 200,000 companies actually collapsed. And that number has only been rising since. The economic model that once made Germany incredibly rich is no longer working. Almost every single year, Germany is now facing a recession. If you look at the country's economic growth, you will notice that up until 2018, Germany was still expanding to a certain extent, then came a recession in 2018. Nearly another one in 2019, and of course, a serious downturn in 2020 during the pandemic. The only meaningful growth that followed was the post-pandemic recovery. But since 2022, recessions have become almost a yearly event. A recession is defined as 2 consecutive quarters of negative gross domestic product growth. You can see one recession here, another one there, and almost a third in between. Recently, the economy started growing again, but only by about 0.3%, which is basically nothing. And with the ongoing conflict in the Middle East, by the end of this year, another recession is very likely, and that one may not stop anytime soon. Now, if you zoom out and look at the bigger picture, it might seem like the German economy is growing. In 2020, the gross domestic product was below $4 trillion, and today it sits at nearly $4.7 trillion. So, what is going on? The truth is that this growth is largely fake. If you look at inflation data, you will see that the increase in gross domestic product mostly reflects rising prices, not real expansion. Since 2022, Germany has experienced massive inflation, almost touching 10%, similar to the rest of the world. That is not normal for Germany. The German people traditionally save a lot, avoid heavy debt, and live with financial discipline. Their government has not been borrowing recklessly like the French, the British, or the American governments. And yet, prices have been growing at a catastrophic pace. Even now, inflation sits at around 3%. So the recent growth is not real growth. It is simply prices rising across the economy. The more people spend and the higher prices climb, the more money circulates and the bigger the gross domestic product appears. Zoom into the German economy since 2008, and you discover something shocking. The economy hasn't truly grown since 2008. Back then, the total gross domestic product was about $3.8 trillion. The financial crisis crushed Germany, and recovery was painfully slow by 2020. The economy stood at roughly $3.9 trillion, almost identical to 2008. Any growth after 2020 came mainly from inflation. In other words, the quality of life for the average German has not improved since 2008. Compare that to the United States, where the economy has doubled in the same period, and the gap becomes obvious. Germany has only grown on paper because too much money is circulating through the system. This is a huge problem, and Germany needs to completely reshape and restructure its economy. If things continue this way, in 5 to 10 years, nobody knows what shape the German economy will be in. To understand why this is happening, you have to go back to 1945. After World War II, both Japan and Germany were completely devastated. Yet Germany rebuilt itself faster than anyone imagined, becoming the most powerful economy in the entire European Union. Even the British economy is nowhere close. But the model that powered that miracle is breaking apart. The first pillar was cheap Russian energy. Russia, just a short distance away, supplied Germany with very cheap liquefied natural gas and very cheap oil. With that abundant, affordable energy, Germany built some of the best cars and electronics in the world and stayed competitive globally. The second pillar was Chinese demand for German machinery and goods. For decades, China didn't build great cars or great technology of its own. So the Chinese elite happily bought Volkswagens, BMWs, and Mercedes. Every major German automaker built factories across China to meet that booming demand. The third pillar was the premium attached to anything made in Germany. People around the world associated German brands with top quality and were willing to pay more for them. Ask anyone in the United States whether they would prefer a BMW or a Chevy, and most will choose the BMW. That same preference fueled enormous sales in China, the United States, and across the world. But this winning formula is no longer working. First, Germany is now overpaying for energy 2 to 3 times what it used to. Without cheap energy, factories must raise their costs and their prices, which makes them less profitable and less competitive. Since 2022, Germany stopped buying cheap Russian energy and switched to expensive liquefied natural gas and oil from the United States. That immediately raised production costs across the country. Second, Germany has lost the Chinese market. China is no longer making inferior products. Today, Chinese cars are genuinely impressive. They may not yet match German quality entirely, but they come very close, and they are significantly cheaper. As a result, Germany cannot rely on Chinese consumers like it once did. Third, China is beating Germany in almost every category. China is essentially producing whatever Germany produces, but cheaper. The reasons are simple. China has economies of scale with a population of about 1.5 billion compared to Germany's roughly 80 to 90 million. The bigger the domestic market, the lower the cost per unit and the cheaper the exports. And China has cheap energy because Russia is now selling its discounted resources to China after losing European buyers. In an open free market, Germany simply cannot compete on price. What Germany should have done is move from manufacturing into software, technology, and artificial intelligence. There are a few German software companies such as SAP, but compared to American giants, they are tiny. The largest software company in Germany has a market cap of about $250 billion. The largest company in the United States has a market cap of around $5 trillion. Even Chinese tech companies are far larger than any German company. Germany hasn't built a Silicon Valley equivalent, hasn't created a powerful tech sector, and isn't leading in artificial intelligence. The United States kept growing because it transitioned from heavy manufacturing into software, technology, and innovation. Germany stayed locked in manufacturing, and in manufacturing, nobody beats China. But that is not the only problem. Germany is on the brink of another catastrophe because its pension system is about to collapse. Germany is a socialistic country with very high taxes and generous pensions. Young workers pay heavy taxes so that elderly citizens can retire comfortably. This only works as long as there are enough young workers to support the retirees. The statistics tell a worrying story. Back in the 1990s, for every elderly person, there were almost 3 young workers paying taxes. Today, that ratio is closer to 1.8 or 1.9. By 2035, it is projected to fall to about 1.3. At that level, the pension system becomes completely unsustainable. That leaves the German government with limited choices. Either raise the retirement age to 70, 72, or even 73, or abolish the pension system altogether. Imagine being a young person in Germany paying 70 or 80% of your income in taxes just to support retirees, with no guarantee you will ever live long enough to collect a pension yourself. If you're in your 50s or 60s, you might accept that. But if you're in your 20s or 30s, the incentive to build a business or career in Germany shrinks dramatically. And this isn't a problem 50 years from now. It is a problem expected within the next 5 to 10 years. It is also not unique to Germany. Almost every European country is facing a similar pension crisis. Many viewers in their 20s, 30s, and even 40s may never receive the pensions they have been promised. The only real way to protect yourself is to build an investing portfolio that can eventually replace your income. If you build a portfolio worth around $1 million and the S&P 500 grows on average about 10% per year, you're essentially generating $100,000 a year from your investments. At first, reaching $1 million sounds impossible, especially if you live paycheck to paycheck. But the truth is, the first $100,000 is the hardest. Once you hit that milestone, the journey from $100,000 to $1 million becomes much easier than most people imagine. The key is to start, stay consistent, and let compounding do the heavy lifting over time. Thanks for watching. This is Money Pop signing out.